everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in today. In the last concept brief, we talked about cash accounting, and today we're going to talk about accrual accounting. This is the other methodology that a company can use to calculate operating income. So, as we said in the last concept brief, cash accounting is good for those companies that can qualify for it, at least for some of them. Because it allows you to recognize cash disbursements and cash receipts on the P&L, so you're taxed on actual cash flow. There are two drawbacks to this. One is you can have a mismatch between revenues and expenses, so it doesn't really capture what's going on operationally in that period. And the other issue is you don't have working capital accounts on your balance sheet, so you're not showing receivables and inventory and payables, so it's can create a false sense of the financial position for the company. Now, accrual accounting, when you use accrual accounting from a P&L standpoint, you're recognizing revenue when that service or good is provided, when the sale is made, regardless of when payment is made. So regardless of when you receive payment. So you have an offsetting receivable in that case. Now, on the expense side, you are going to recognize expenses when you are consuming those expenses, regardless of when you are making payment. So the P&L is very well matched. Revenues and expenses are matched, so it accurately shows the operating activity in that period. So likewise, on the balance sheet, you're going to have the working capital accounts are going to show up, because when you are recognizing expenses and revenues, regardless of when payments are made, you are going to have either two impacts. One is you're going to have cash payment, or two is you're going to have a receivable in the case of sales, and you're going to have a payable in the case of expenses. So you're going to have these working capital accounts. So it's going to accurately show the financial position of the company. So in a lot of ways, the strengths of accrual are the converse of the weaknesses of cash-based accounting. So we'll go into these concepts more. The next number of concept briefs we're going to do, or we're going to stay on accounting. It's very foundational for finance, and then we're going to move on to finance subjects. But we're going to stay with accounting for a while. Thank you for tuning in.